Welcome to the lecture on retirement planning, and after the lecture we will be able to learn the following objectives. Explain the concept of financial planning, describe the financial planning process, discuss the steps of the financial planning process, explain the importance of financial planning, define long-term financial planning for businesses, understand development and implementation of a financial plan. Let's start with a brief introduction of retirement planning. Today, people anticipate active, vibrant retirements in which they enjoy life and economic self-sufficiency. They see retirement not as the short final phase of life, but as the reward phase of life, the icing on the cake. Moreover, a significant percentage of the population has become increasingly interested in achieving the financial independence currently associated with retirement. Retirement may last longer than planned because life expectancies continue to rise. People retiring now at age 65 can reasonably expect to live 20 or more years in retirement. Financial advisors who engage in retirement planning must be prepared to answer some tough questions. The financial advisors need to be equipped with the knowledge and tools to properly serve their clients' retirement needs. Let's now take a look at the role of the retirement advisor. Retirement planning is a multidimensional field. As such, it requires that the advisor be schooled in the nuances of many financial planning specialties and related areas. A client is better served by a team of advisors who have specialized complementary backgrounds, or by a single advisor who is educated and experienced in a variety of important requirement topics. Holistic retirement planning. Under holistic retirement planning, the advisor must communicate with clients concerning such topics as employer-provided retirement plans, Social Security considerations, personal savings and investments, income tax issues, insurance coverage, IRAs and Roth IRAs, Medicare choices, tax planning for distributions and other distribution issues, health insurance planning, wealth accumulation for retirement, selecting a retirement community or another living arrangement. Responsibilities of the retirement advisor. Financial advisors engaged in retirement planning must accept several responsibilities that may not have been a part of their traditional financial practice. These aspects of a retirement planning practice include incorporating retirement planning as a segment of comprehensive financial planning, dealing with other professionals who advise the client, dealing with relatively young clients, monitoring and/or updating the client's plan. Here we will discuss the retirement planning and the financial planning process. As one of the major planning areas that should be part of any comprehensive financial plan, retirement planning follows the same process used in financial planning. Step 1. Establishing and defining the client-planner relationship. Retirement planning begins with advisors meeting with the client, establishing rapport, and clearly defining what the client-planner relationship will be. Step 2. Gathering information necessary to fulfill the engagement. After the client understands and indicates acceptance of pursuing the retirement planning engagement, The next step is also vitally important. Step 3. Analyzing and evaluating the client's current financial status. In this step, we take one look at the client's current situation and their retirement goals to evaluate appropriate strategies for the client. Step 4. Developing the recommendation or recommendations. Investments should be summarized, and one should recommend an investment policy. The retirement plan should also include an assessment of distribution options and tax strategies. Finally, the plan should include a list of prioritized action items and address issues such as housing, healthcare, and long-term care. Step 5. Communicating the recommendation or recommendations. Normally, the retirement plan will be presented in writing, although single-purpose plans such as a retirement plan rollover into an IRA may not be in a formal written report. This step in the retirement planning process requires one to get the client's acceptance of recommendations and agreement to move towards implementation. Step 6. Implementing the recommendation or recommendations. A plan that is never implemented is an exercise in futility. After all work in meeting with the client, gathering data, developing recommendations, and obtaining client's approval, do not drop the ball at this point. Part of next responsibility is to motivate and assist the client in implementing each step of the retirement plan. One should plan to meet with most clients at least once per year and more frequently with some. Let's now get to know about the art of financial planning for retirement. To be a successful financial advisor, one must have a working knowledge of a variety of financial planning and retirement-related topics, and know how to apply that knowledge to a client's particular situation. As a financial advisor, primary responsibility in the art of financial planning for retirement is to make clients aware they are making choices about their retirement every day. Two other important facets to financial planning for the retirement exist. First, the advisor must devise different retirement strategies for clients who are prepared for retirement than for those who are not prepared. Second, the advisor must help clients overcome roadblocks to retirement savings.
This is what it's like to be a financial advisor. My name is Janice Dunn, and I'm a certified financial planner here in Eugene, Oregon. And the thing that we specialize in is looking at someone's overall financial picture and trying to find out if there are ways that they can make that picture better, save for retirement, save for education for their children, maybe pass on money to their heirs if they would like. Generally, we look at taxes as part of that picture and investments as part of that picture, and that can be everything from real estate to metals and commodities, all different kinds of things that you can put money in, and then hopefully later it'll be worth more money than you had. The coolest thing about it really is that every person's plan usually is as different as their fingerprint, and so it's really fun to work with people because everyone has a different.
Older clients still need to plan for retirement. Retirement planning, however, takes on different characteristics for different age groups, and one must deal with clients of all ages. Starting young, however, can mean all the difference in the world. Clients must make important decisions about distributions from qualified plans, liquidation of personal assets, and investment of private savings. Developing retirement plans for clients who have procrastinated involves determining what funds are available for retirement and creating strategies, even if the funds are inadequate. Qualified Domestic Relations Order, QDRO. Another roadblock to saving for retirement is incurred by a divorced client. Divorce often leaves one or both parties with little or no accumulation of pension benefits or other private sources of retirement income. QDROs are judgments, decrees, or orders issued by state courts that allow a participant's plan assets to be used for marital property rights, child support, or alimony payments to a former spouse or dependent. Roadblocks to retirement saving. Tendency to spend all income. Unexpected expenses. Inadequate insurance coverage. Divorce. No employer plan available. Frequent employment changes. Lack of financial literacy. Other accumulation needs.
A Qualified Domestic Relations Order, or QDRO, is a judgment that relates to the provision of child support, alimony payments, or marital property rights for the benefit of a spouse, former spouse, child, or other dependent of one of the parties. Subsequent to a divorce or legal separation, this order allows the pension plan to pay benefits to someone other than the individual participating in the plan. A state authority must issue a judgment before it can be a domestic relations order. Under ERISA, a signed agreement alone is not sufficient. The QDRO may be a separate document or it may be part of the divorce decree, as long as it meets the standards for a qualified domestic relations order.
Let us now take a look at how to develop a retirement plan. Estimating a client's financial needs during retirement is not an exact science because it entails trying to predict the future. Such estimates are filled with complicating factors and clouded by unknown variables. A failure to plan is certainly tantamount to planning to fail for most clients. Moreover, changing variables can be overcome if the retirement plan is monitored and evaluated periodically. The retirement planning process involves determining the standard of living the client expects during retirement. One must also determine where the client stands financially for retirement purposes. This involves gathering the data and adding up the client's existing resources. Replacement ratio method. The replacement ratio method of determining retirement income assumes that the standard of living enjoyed during the years just prior to retirement will be the determining factor for the standard of living during retirement. For clients at or near retirement, it is much easier to define the target. Reduced taxes. Tax advantages for the retiree include the elimination of Social Security wage-based tax, the health insurance tax, an increased standard deduction depending on the retiree's age and filing status, the exclusion of all or part of Social Security retirement benefits from gross income, reductions in state and local income taxes, and increased ability to use deductible medical expenses. Reduced living expenses. Retirees incur a variety of changes in spending patterns after retirement, and some of these changes will reduce their living expenses. These reductions often include the elimination of work-related expenses, such as purchases of uniforms or equipment, no home mortgage expenses, no dependent care, that is, child-rearing expenses, the elimination of long-term savings obligations, and a reduction in automotive expenditures. Additional factors. Retirees also face several factors that may increase the amount of income they will need during the retirement period. These may include increases in long-term inflation, medical expenses, travel expenses, and in other retirement-related expenses. On the other hand, many retirees typically spend less in their retirement when travel and other activities become more difficult to manage. Expense method. The expense method of determining retirement income focuses on the projected expenses the retiree will have. As with the replacement ratio method, it is much easier to define the potential expenses for clients at or near retirement. Some expenses that tend to increase for retirees include the following: utilities and telephone, medical, dental, drugs, health insurance, house upkeep, repairs, maintenance, property insurance, recreation, entertainment, travel, dining, contributions, gifts. The effects of inflation. To calculate the true retirement income needed, the financial advisor must provide inflation protection both before and after retirement for all the client's resources. To accomplish this, identify which of the client's resources are subject to a decline in purchasing power due to effects of inflation. Any Social Security retirement benefits the client might receive may not be subject to a decline in purchasing power because Social Security is indexed each year to reflect inflation. The client should fund for an amount that can be used to bolster a non-inflation protected pension benefit during retirement. Let's now have a look at the potential sources of retirement income. Advisors must know the potential sources of retirement income available to a client and how the sources can be optimized during the retirement years. For purposes of this discussion, various types of tax-advantaged retirement plans can be divided into qualified plans and those that are not. Qualified plans are those subject to Code Section 401A and include defined benefit pension plans, cash balanced pension plans, money purchase pension plans, target benefit pension plans, profit sharing plans, 401k plans, stock bonus plans, and employee stock ownership plans, ESOPs. Non-qualified plan. Most advisors use the term non-qualified plan to refer to deferred compensation plans instead of the tax advantage plans identified, the SEP, SIMPLE, or 403B plan. Unlike tax advantage plans, non-qualified plans are generally for only a few key people and have few design restrictions regarding the benefit structure, vesting requirements, and coverage. Tax-advantaged qualified plans. Qualified plan. The most valuable way to save for retirement is through a tax-advantaged qualified plan. A financial tax advantage afforded by qualified plans is that distributions from these plans can be rolled into an IRA or other tax-advantaged plan with retirement income. Under this method of categorizing, one type of plan includes the employer's promise to pay an annual retirement benefit, a defined benefit plan. A second type of plan is based on the employer's annual contribution to an employee's individual account, a defined contribution plan. Defined benefit versus defined contribution plans. All qualified plans are either defined benefit or defined contribution plans. Under a defined benefit plan, the required employer contributions vary depending on what is needed to pay the promised benefits. A defined benefit plan typically uses a benefit formula to stipulate a promised retirement benefit. This promised benefit is typically a percentage of the employee's salary. Defined contribution plans do not promise to pay a specified retirement benefit. Instead, they specify or define the contribution the employer will make annually to an employee's individual account. The maximum annual contribution made to a defined contribution plan on behalf of an employee must not exceed the lesser of $50,000 as index for 2012, or 100% of the employee's compensation. Types of tax-advantaged qualified plans. After understanding the basic characteristics of each category of qualified plans, we are well on the way to understanding the specific type of plan the client has. The final component one needs to understand is the plan's benefit or contribution formula. These formulas are unique to the specific type of plan involved. Defined benefit. Pension plan. Unit benefit. Formula. Defined benefit pension plans. As its name implies, a defined benefit pension plan is both a defined benefit plan and a pension plan. The employer's contributions under this type of plan are determined based on the benefits promised by the plan. The most common type, the unit benefit formula, directly accounts for both the participant's service with the employer and the participant's salary in determining the pension benefit. Cash balance pension plans. A cash balance pension plan is a defined benefit plan designed to look like a defined contribution plan. As a defined benefit plan, employers are committed to funding it each year, but its defined contribution look means that its benefit formula is more easily explained to employees. The heart of the cash balance pension plan is the benefit formula. As in a defined contribution plan, the benefit is stated as an account balance that increases with contributions and investment experience. However, in the cash balance plan, the account is fictitious. Money purchase pension plans. A money purchase pension plan is a type of defined contribution plan. It is also, as its name states, a pension plan. Under a money purchase pension plan, the employer's annual contributions are mandatory and are specified in the plan. Target benefit pension plans. A target benefit pension plan, like a money purchase pension plan, is both a defined contribution plan and a pension plan. Thus, target benefit plans have many of the same characteristics as money purchase plans. Profit sharing plans. A profit sharing plan is also a type of defined contribution plan. Under a profit sharing plan, there are two parts to the contribution formula. In most profit-sharing plans, employer contributions are made on a discretionary basis. This means the employer decides whether a contribution will be made and how much that contribution will be. Stock bonus plans and ESOPs. Stock bonus plans, ESOPs, and profit-sharing plans are all defined contribution plans and fall into the profit-sharing category. Both stock bonus plans and ESOPs typically invest plan assets primarily in the employer's stock. Profit-sharing plans, on the other hand, are usually structured to diversify investments and do not concentrate investments in employer stock. Other tax-advantaged plans. There are three types of tax-advantaged retirement plans that are not technically qualified plans. These are the Simplified Employee Pension, SEP, the Savings Incentive Match Plan for Employees, SIMPLE, and the 403B plan. We shall see that each of these plans has its own unique set of rules. A Simplified Employee Pension, SEP, uses an individual retirement account, IRA, or an individual retirement annuity, IRA annuity, as the vehicle for contributions. SIMPLE Savings Incentive Match Plan for Employees. Any type of business entity can establish a SIMPLE. However, the business cannot have more than 100 employees. the employee's maximum salary deferral contributions are less under a simple than with qualified plans such as a 401k. Salary deferral contributions. The maximum salary reduction contribution that can be made by an individual is subject to the same dollar limitations that apply to 401k plans. In qualified plans, distributions can generally be rolled over into an IRA, which will delay taxation until the client withdraws funds as required from the IRA. Non-qualified benefits cannot be rolled over into an IRA. Active participant. The first eligibility issue concerns whether the client is an active participant in an employer-maintained plan. The term active participant has a special meaning that depends on the type of plan involved. In the case of a defined contribution plan, a person is an active participant if the plan specifies that employer contributions must be allocated to the individual's account. This category also includes SEPs, 403B plans, and Simples. Here we will discuss about overcoming inadequate retirement resources. In addition to determining how much income clients will need to retire, one should understand how to help clients produce as much retirement income as possible from their existing resources. The final part addresses 4 strategies that can recommend to accomplish this objective. Trading down to a less expensive home. Obtaining a reverse mortgage. Post-retirement employment pension maximization. Trading down to a less expensive home. If a client sells their home and relocates to a smaller, less expensive residence, the money from the transaction can be a valuable source of retirement income. During the prior 5 years, the house was owned and used by the taxpayers as their principal residence for periods aggregating 2 years or more. Obtaining a reverse mortgage. Often, a client would like to take some equity out of their home, but is reluctant to sell it and move to a less expensive one. A reverse mortgage is a non-recourse loan against an individual's home that requires no repayment as long as the individual lives in and maintains the home. Post-retirement employment. A third strategy to provide the retiree with extra cash is a part-time job during the retirement years. Many retirees find that working on a scaled-back basis not only meets their financial needs, but also helps them adapt psychologically to the changes that retirement brings. This is especially true for retirees whose self-esteem and sense of worth were tied to their careers. Pension maximization. The final strategy we will discuss here is so-called pension maximization. Qualified plans typically stipulate the type of distribution the client will receive. The normal form of benefit for a married client is a joint and survivor benefit that pays between 50 and 100% of the joint benefit amount to the survivor. If a married client elects a benefit paid in the form of a life annuity, he or she can increase their retirement income significantly. Now, in the end, let us summarize what we have learned in this lecture. Instead of waiting until one is middle-aged or older to start planning for retirement, it is best for people to start planning when they are relatively young. Retirement may last longer than planned because life expectancies continue to rise. People retiring now at age 65 can reasonably expect to live 20 or more years in the retirement. Retirement planning is a multidimensional field. As such, it requires that the advisor be schooled in the nuances of many financial planning specialties and related areas. The retirement team, or the multi-talented individual, is the vehicle. The holistic approach to retirement planning is the only means by which a client's needs are fully and adequately met. The advisor must integrate retirement planning strategies with other financial planning needs such as tax, estate planning, and investment goals.